听见资本，本期视频为您带来的是摩根大通在3月14日关于欧洲利率市场的话题。近期德国财政政策的重大转变引发了全球市场的广泛关注。德国政府推出大规模财政刺激方案，叠加欧盟委员会提出的8000亿欧元防务支出计划，推动了欧洲债券市场的结构性变化。德国10年期债券收益率因此创下纪录单日跌幅，市场对期限溢价的不确定性定价也在上升。这不仅提振了德国的经济前景，还带动欧元区整体增长预期上调，影响了欧洲央行的货币政策路径。欧元区内部利差的收窄同样引人注目。德国财政扩张为区域增长注入活力，利差有所收紧，但德国相对于其他国家的增长差异可能带来扩大的压力。市场也在重新评估收益率曲线前端，对欧洲央行最终利率的预期上调，反映了对未来政策的乐观调整。而掉期利差的变动，特别是德国国债掉期利差收窄，显示市场在消化发行量增加和期限溢价的影响。英国国债市场则出现显著抛售，10年期利率升至 4.7% 左右，这既是对德国收益率变动的跟随反应，也受到美国关税不确定性的持续影响。国内方面，即将发布的财政大臣春季预测更新增添了不确定性，市场情绪因此承压。在这一背景下，摩根大通深入剖析了欧洲利率市场的动态，探讨德国财政转向如何重塑市场预期，并展望未来走势。这些变化究竟如何影响全球金融格局，值得我们持续关注。接下来是英文会议的全部内容。如果您需要英文原稿和我的投研助理人工校对的中文文本，您可以在频道的 Patreon 上获取。
Hi, and welcome to At Any Rate, JP Morgan's global research podcast, where we take a look at some of the drivers behind the biggest trends and themes across fixed income, currency, and commodity markets. I'm Francis Diamond, Head of European Rate Strategy at JP Morgan, and today I'm joined by my colleagues Aditya Choudhary and Kayendra Gupta to discuss our current views on European rates markets against the backdrop of the seismic shift in German fiscal policy last week and the repricing in European rates markets we've seen with ongoing tariff uncertainty still in the background. We're recording this podcast on the 14th of March, and our comments today are based on published research available on JP Morgan markets. So 10-year bund yields did see their record one-day sell-off of around 30 basis points following the fee change shift in German fiscal policy last week, alongside an increased market pricing of term premium uncertainty. And that's left 10-year bund yields just below the 3% level currently. It looks like a deal on the German fiscal package appears to have been reached, and that likely will be voted through in Parliament next week at some point. And certainly euro area-wide, there is now a clear shift in thinking towards higher defence spending, but I think the definitive policy decisions from other countries have yet to be seen. Our economics team has revised the German euro area growth forecast expectations for this year and next year higher, and also changed the ECB call, with now 2 more cuts expected and a terminal rate view of 2% depot by September this year. So Aditya, let's start with the German announcement, the massive sell-off in bund yields we've seen over the past week or so. How do you interpret these market movements in light of the announcement, and what are your thoughts on the current level of bund yields here?
Sure, Francis. Like, the German fiscal U-turn has been a big surprise. Like, I think even that would be an understatement. And it was a surprise not just for us, but also for the market, as you can see by the sharp, steepening moves you've seen in the markets over since the announcement. Like, the German yield saw almost a 30 basis point sell-off in the long end, which was the biggest single-day sell-off in the known history, at least since the 1990s. When we think about it, there are 2 channels from the German fiscal announcement that should be moving the 10-year German yields higher. Like, first being higher ECB policy rate expectation on stronger growth outlook coming from this higher fiscal spending in Germany, and also broader increased defense spending across the region. And second, the impact from higher issuance on term premium pricing. And that is, again, a big theme in the markets, not just in Germany, but recently has been the case in US and UK over the past couple of years. As you highlighted, ICON has now revised higher the terminal expectation by 25 basis points for ECB, and now we're expecting the ECB to pause or stop at 2% instead of a 175 expected previously. And also previously we were highlighting a significant downside risk to a 175 target. Now that downside risk is a bit more limited. Definitely not balanced, still risk is downside, but still a bit limited risk now around the 2%. So a revision higher of terminal rate expectations should put upward pressure on 10-year German yield projection, roughly around 20 to 25 basis point higher 10-year German yields versus what we were expecting before makes sense to us. Also, during the recent sell-off, along with the move high in ECB rate, terminal rate expectation, what has also happened is that the money market forwards, like in the 2-year forwards, 3-year forwards case, have steepened sharply, which in our view could be driven by factors like higher expectation of medium-term R star for the euro area, given this whole increased growth optimism, or also due to position technicals. Again, this steepening of the curve has again put upward pressure on the German yields, let's say roughly around 10 basis points or so. This part of this component of repricing for us looks a bit excessive for the time being. And also, lastly, as I mentioned, it's the term premium repricing, which is the one which is a bit more harder to estimate. Historically, we have found little evidence that realized bond supply on its own has been a significant persistent driver of duration of curve moves over a longer run. Like, we didn't find any evidence when we did some of this analysis, at least till early 2023. But at the same time, over the past few years, the focus on term premium has increased significantly across DM space, and we believe that this term premium narrative will remain strong on German curve until there's clarity on the macro impact of this fiscal. So I believe, like, currently the German, let's say the 10-year yields are pricing roughly around 15 basis points or so of term premium, and that term premium might stay stickier and might only fade gradually over the medium term. So when I put all these things together, I find the recent, let's say, around 50 basis point sell-off on German yield we have seen since early March seems reasonable when you decompose into these factors. But I believe, like, the term premium, a bit of higher terminal expectation, and also the medium-term RSI expectation will gradually fade, and hence I still target a German yield which is lower than from current levels around 290, and aim 10-year Germany to settle around 250 basis point area by, let's say, mid to late this year. So overall, we still expect the direction of the yield should be lower going forward, but near term, I think we warrant a bit of caution given the heightened uncertainty. So yeah, like, medium term, I think market should be lower, but near term, a bit of caution.
Okay, so that's pretty clear in terms of where we see the levels here and the impact of the term premium. But let's be a little bit more drilling down, I think, in terms of views around the exact impacts and channels for German fiscal issuance. And particularly, there's been a lot of focus here in terms of the fiscal dynamics, what that does to the issuance profile from Germany over this year and next year. Maybe if you could just summarize what you're thinking here for us, that'd be good.
Sure. I think just a word of like a caution disclaimer before I do any calculation. Like, this is still an ongoing or developing story, and there's still a lot of uncertainties around the estimation of any of these fiscal issuance projections. But when we, like ourselves, like include, and when we work with our economists, we figured out that the new spending on defense, infrastructure, and state and local regional level in Germany under the new fiscal plan could amount to roughly 3% of GDP of extra spending on annual basis. But at the same time, there would be other parts of the budget that are likely to see some consolidation, and also higher growth would improve the cyclical part of the budget. So even though, like, optically it will look like, oh, just the deficit has increased 3% from the current level, but I think given the consolidation on the existing budget or other parts of the budget, the overall increase is smaller. We believe the deficit will only reach around 4% in Germany by 2026 versus current level, which is close to 2.5. And for 2025, the deficit might only reach around 3.5% range. So a percentage point higher, or half to 1 percentage point higher, because most of spending will start somewhere around mid this year. So you have to take only half of a year into account. So the deficit are definitely increasing, and hence funding will be increasing, but the numbers are not as large as we initially thought. So based on these assumptions, we see the German 2025 net federal issuance, so which includes both bonds and bills, to increase by roughly 45 to 65 billion versus to a number around 90 to 115 billion of net issuance this year versus the previous estimate of around 48-50 billion. So decent increase. Similarly, for 2026, as we expect the deficit to go closer to 4% than the previous expectation of 2%, we see the German net funding needs increasing by 90 to 115 billion to roughly 130 to 155 billion. This is roughly definitely a big increase. But what we are stressing that also in case of Germany, all the funding increases are not necessarily going to be fully funded by bond issuance. Germany tends to use a variety of channels, which includes bond issuance, but also includes T-bill issuance, repo activities, etc. Just for example, in 2025, the old official projections, so which were made at the late part of last year, they were assuming a negative net T-bill issuance. So the T-bill stock was expected to decline by 20 billion, and the net bond issuance was roughly around 68 billion or around 70 billion. So our belief is that if Germany is going to increase the funding needs of this year, this negative net issuance of T-bill might go to zero. So like T-bill stock might remain flat or even increase. So of the 40 to 45 to 65 billion increase we're expecting, at least 20 billion can come from bills, if not more. So yeah, like the full pressure is not necessarily on the bonds. So that's a very interesting point to notice when you're looking at the market impacts.
Okay, thanks. So maybe if we shift a bit more to another area of focus over the past couple of weeks and the tightening in intra-EMU spreads, which I guess, given the large German underperformance, sort of makes sense. But in terms of valuations, in terms of macro drivers, where do you think intra-EMU spreads can go from here?
Sure. So when I look at my fair value frameworks for intra-EMU spreads, the way the recent fiscal developments can impact the spreads, there are like three channels. The first being tightening pressure on intra-EMU spreads, or spreads being tighter, coming from improving euro area growth prospects, euro area growth outlook. So effectively, better the growth, lower the credit risk, and hence tighter the spreads. The second is widening pressure coming from let's say German PMI outperformance or German growth outperformance relative to the rest of the region. What it means is that over the past few years, a good part of intra-EMU tightening can be explained by German relative growth underperformance versus the rest of the region. Now, given the strong fiscal push coming in Germany, I think this dynamics can get reversed, and hence that will put some widening pressure. And also, lastly, there is a widening pressure coming from elevated volatility, which over the near term also can put pressure on spreads, but over the medium term, maybe it might be neutral. So overall, I think there are these offsetting factors, and it's very hard to calibrate them at this point of time because we exactly don't know the growth impact and the relative growth impact without knowing the actual final fiscal package and how the execution will happen. But overall, we believe that given these offsetting drivers, we don't expect intra-EMU spreads to do much or stay stable around current levels over the medium term. However, over the near term, our bias is to be more cautious on intra-EMU spreads because we believe at current levels, we do find both periphery and core spreads trading a bit more expensive, let's say 3 to 5 basis points on our fair value framework. But more importantly, we believe that the positioning, which was heavy on carry trades in the 3 to 5 year parts of the curves, there is a risk of a bit more liquidations in case of a risk of or heightened uncertainty. So for me, a bit of caution is warranted over the near term, but medium term, I don't think intra-EMU spreads are going to do much.
Okay, thanks. Maybe if we bring Tigendra in here now and sort of focus a bit more on the very front end of the curve. Obviously, we've seen a repricing out of around 25 basis points of ECB easing. Terminal rate pricing is round about the 2.1% level. So, Tigendra, does that seem reasonable in your view, given what we've seen in terms of the recent macro and particularly German announcements and developments?
Hi, Francis. Yeah, in a one-line answer, I think the current levels at the front end of the curve seems very reasonable to me. I mean, German fiscal easing, as you mentioned earlier, and Aditya reiterated, will also help the euro area growth and inflation prospect. And obviously, we have revised both of these higher over the last few days, which also biases, as Aditya mentioned, the ECB terminal rates higher. Now, this needs to be priced into the front end of the curve as well. Previously, before all these announcements, we had penciled in a range of about 1.8 to 2% for 1 year Ester, but these events have raised the ranges about, in my mind, about 20 basis point higher, and we now expect 1 year Ester to be in a 220 range. That's currently at around 210. The level seems fair to me. However, from a trading perspective, we prefer to trade this from the long side on any significant cheapening from here, given lingering risks coming from the U.S. tariffs and its impact on the euro area economy. We have accounted for some of this impact in our forecast, but we remain mindful of any acceleration of this over the coming days and weeks. For now, at the front end of the euro curve, we prefer to hold low beta long duration proxies, and interested listeners can read more about these in our recent publications, where we discuss all of them in very details.
Okay, great. So we've already discussed a bit with a DTR, the term premium in the German curve and the level of 10-year valuations, but I guess another place we can kind of look for this and try to identify the moves here is in swap spreads, and certainly 10-year German swap spreads have been trending narrower over the past few months. We then had the German fiscal announcement drove another leg of this narrowing. So how do you interpret these moves in your view?
On spreads, I think it's best to split them into front end move and then further out. So short spreads have been, overall stable, having retraced all the knee-jerk narrowing, which was about 4 or 5 basis point last week, that was seen immediately after the German fiscal announcement. Now, I expect short Ester spreads to be in a let's say -7 to -12 basis point range versus current level of somewhere around -9. I don't have a strong directional bias at the moment on short spreads, but would favor narrowers on any sharp widening move, which, let's say, going closer to our upper end of the range. On bunds, the initial move in my mind was too excessive, and when bunds Bund Ester went down to -30s last week. And obviously, over the last few days, spreads have retraced somewhat wider and are closer to, but still, I would say, a few basis points cheap versus fair value in our analysis. Now, I believe this mispricing is likely to stay over the near term, as there remains uncertainty on the amount and timing of issuance in Germany, and then its consequential impact on spreads. I interpret this mispricing as markets' expectation of how much of term premium, or how much of issuance is being priced in, and its impact on spreads. We have discussed in our earlier publications that estimating the beta of swap spreads to issuance is, in my view, a futile exercise, as historically the betas have been dependent on time frame of the regression model, and to a large extent on other regressor variables used in the model as well. Now, we have estimated the betas somewhere between 2 to 6 basis point of narrowing per 100 billion increase in issuance from the various iterations of my Bund swap spread model. Now, crucially, as I mentioned, spreads still flash cheap in all these models, suggesting that market is likely overpricing the impact of issuance on spreads. Now, nevertheless, I'm reluctant to fade these moves on an outright basis, as these cheapness could remain on the near term, and instead I prefer to harness the strong negative directionality of Bund spreads to yields and prefer to trade spreads conditionally. So I do like Bund bull wideners and bear narrowers. Now, Francis, if I turn it over to you, UK, and talking about UK, the UK gilts have sold off over the past couple of weeks. How are you viewing this? Is it just a beta move to bunds, or is there a domestic driver as well?
So yes, you're right. I mean, 10-year gilt yields have sold off pretty significantly over the past couple of weeks. The level of 10-year rates is now around 4.7. But I do think, as you kind of alluded to there, the bulk of this move does reflect a pretty strong beta to sell off in German yields rather than anything that's particularly UK Pacific. And I think this can continue in terms of German fiscal developments plus ongoing US tariff uncertainty. We also have the Fed's meeting next week. I mean, I think these continue to be external factors that can drive or impact UK yields in the near term. But I think there is a domestic angle here that is probably weighing on markets to some degree. We have the upcoming spring forecast update from the Chancellor, which I do think is also having some degree of, let's say, fiscal uncertainty impact on the intermediate part of the gilt curve. I mean, similar to what we've seen in Europe and elsewhere, there has been an upward revision from our economics team in terms of the UK growth forecast, but the upward revisions here are a lot smaller in terms of we're now seeing full year 2025 and 2026 GDP both around 1%. I mean, that's roughly 1/10 and 2/10 higher respectively from what we had previously. So I don't think there's a huge UK macro story or growth revision story here that is driving UK rate markets. I think it is just this uncertainty around what the OBR forecasts may well deliver. And in terms of the BOE, I mean, similarly, we did have an easing path in terms of BOE. It delivers gradual easing. We think that's still the case. I think the BOE will be easing 25 basis points in May, but possibly the end point in terms of where we get to on the terminal rate is maybe just a little higher than we previously thought into 2026. And I think really it's this idea around what we've seen in the data recently with growth outturns that are much weaker than the OBR forecast back in October. That is already limiting fiscal capacity in terms of what the government could well do to sort of replicate some of the focus on defence spending we've seen in Europe. And I think we probably expect, if anything, at the spring update, the UK government is going to have to make some adjustments to incrementally tighten fiscal policy in a few weeks' time, rather than sort of be able to deliver anything that goes in the opposite direction. And they have to really prevent the government breaking its own fiscal rules in terms of the headroom that the forecasts imply by the end of the forecast horizon. So I think from a market standpoint, I think there are some risks here around the government can present its growth and spending forecasts in light of the updated OBR revisions. It has to be able to present these in a way that are credible and don't erode sort of any credibility in terms of the ability to deliver forecasts or particularly spending and growth forecasts that seem unrealistic over the medium term. And we do think you need to see some details here, or at least enough details in terms of what measures the government is potentially thinking about here to avoid having negative headroom and negative sort of budget headroom against its fiscal rules. So I think this uncertainty will keep 10-year gilt yields elevated around current levels over the next few weeks. I mean, similar to, as Aditya discussed in Germany, probably from a sort of a medium-term valuation perspective and our forecast perspective, we do think yields can be lower from here. But for now, I think we just need to stay a little bit cautious and sort of just avoid any real driven views here. I mean, one final word in terms of the issuance remit. We will get a DMO remit for fiscal year 25-26. We've tweaked our prior forecast. We now expect gross gilt sales to be just over 300 billion compared to roughly 285 billion we had previously and our initial 2025 supply update at the start of this year. So that's all from us. Thank you for listening. Stay tuned for more updates on the fixed income space here on At Any Rate, JP Morgan's Global Research podcast series. This communication is provided for information purposes only. Please read the JP Morgan research reports related to its contents for more information, including important disclosures. Copyright 2025, JP Morgan Chase & Co., all rights reserved. This episode was recorded on the 14th of March, 2025.